If you have a loss from a sale of a rental property, assume that you held it for more than 1 year. Can you use it to offset your active income? Yes or no? Here are the rules when it comes to losses from real estate. So you still have to pay depreciation recapture. And the answer is so let me pull up our slides for today.
Another year, another pile, numbers stacked up mile by mile. It's time to sit, reflect, and add. Doing taxes ain't so bad.
So let me pull up our slides for today. What we're going to be talking about today is what happens when you have a bad real estate deal. Is it all bad if you lose money on a real estate deal? Is there a silver lining to all this? Can you get some kind of a tax benefit if you have a loss on a real estate deal? So that is what we are talking about today. Specifically, we are going to be talking about a 1231 loss. Okay, so who am I and why the heck should you be listening to anything I'm saying? So my name is Jason Malbute. I've been doing tax and accounting since 2013. I've been a CPA since 2015, and I've been a real estate investor since 2018. I've done single family, multi-family. I've invested out of state. I've had great deals, I've had not so great deals, I've had clients who had big gains, and I have clients who have losses on the deals as well. So I've been there and seen it all. And I'm also a certified tax coach, which is a fancy word to say that I am trained and certified to help you with your tax planning needs. So here's a question. If I sell my rental at a loss, can I deduct it? That is a question that we are going to be answering today. And also, if we can deduct it, how much of it can we deduct? Can we deduct just a portion of it, or can we deduct the entire amount? So please pay attention, because at the end of today's webinar, we'll be asking you a pop quiz. And if you answer it correctly, you will get a special prize. This prize is worth tens, if not hundreds of thousands of dollars, so you definitely don't want to miss out here. Okie dokie. So myth versus reality. Here's a myth that most people think is that if they sell below what they paid for the property, it creates a tax loss. That is not always the case, because there are some instances where even though you sell it below what you paid for it, it might not always equal a loss. And I will show you an example of when that is the case. Because remember, the gain or the loss is not based on the cost of the property, but rather the adjusted basis. So it's the cost minus certain adjustments, which we are going to be talking about in a few seconds here. So remember, gain or loss results from proceeds minus adjusted basis, not the cost of the property. So what are the adjustments to adjusted basis? So it's purchase price plus improvements plus certain closing costs minus accumulated depreciation. So that means the depreciation that you've taken in previous years, you will then subtract that from the purchase price plus the improvements plus closing costs to get the adjusted basis. Okay, and then that adjusted basis is what you will subtract from the proceeds to get the gain or loss. So here are the rules when it comes to losses from real estate. So real estate by default is considered passive losses. Okay, so what does that mean? Passive losses can only offset active income. So not unless you qualify for real estate professional or other tax exemptions or rules, then what's going to happen is that those passive losses from your rentals can only offset other passive income, aka you cannot offset your W-2 income or your active business income with passive losses normally, unless you, for example, qualify under real estate professional. But let's assume that you don't qualify for real estate professional. That passive loss that you have, you can use that to offset another syndication deal. So let's do a real life scenario here. So let's say Billy Bob, he is a real estate investor. He invests in multiple syndication deals. One deal that he bought 3 years ago, he is selling now for a gain. Well, that gain is considered passive income. Then what he could do as part of tax planning is he could find another syndication opportunity where they are doing bonus depreciation, cost segregation. That is going to result into a loss, a passive loss. And then that passive loss can help offset that passive income from the sale of the syndication deal that he was a part of. That's what this slide talks about. Just making sure that I don't miss anything here. So Again, if you qualify for real estate professional, then that's the time that we can use those passive losses to offset active income, like W-2 income or active business income, for example, Schedule C income. Okay, so why does depreciation change everything? Because depreciation is one of the biggest gifts from the government. Because the government gives you this phantom loss, paper loss, and you could deduct on your tax returns, right? And I want to clarify what I said. It gives you a phantom deduction. It gives you a phantom expense that could potentially create a loss. And then that loss can be used to offset passive income, or if you qualify for real estate professional, it could offset active income. So you could have a loss on paper, but still be profitable in real life. The not so great thing about depreciation that people don't talk about is that when you sell the property, you need to pay depreciation recapture up to 25%. So what does that mean? So that means that if your tax rate is lower than 25%, then you'd only pay that rate. You wouldn't have to pay a full 25% for depreciation recapture. That's something that a lot of investors and CPAs get confused on. So here is an example. Okay, so they purchase a property for 500,000. Accumulated depreciation to 120,000. So then therefore adjusted basis is 380,000. If they sell it for 430,000, that would still be a gain, even though they purchased it for more than they sold it for. So I just wanted to show you how the adjusted basis could be lower than the purchase price after you consider the adjustments like accumulated depreciation. So this just shows that you can still lose money on a deal and still owe taxes, which is very scary, especially for people who are in syndication deals right now, who are losing their capital that they're investing in these syndication deals, and there's still a possibility of them owing taxes on those deals, which we're going to be talking about in a few seconds. You can still lose money on your property and still owe taxes if you are a guarantor on a loan, and part of that debt is forgiven after the sale. Because let's say you sell a property for less than the mortgage amount, then that difference is considered forgiven, and you are taxed on that amount, and it's considered ordinary income. Okay, so that's something to be aware of, especially if you are signing off on loans or deals. So this is something that we talked about already a few minutes ago. Depreciation recapture. If you sell the property for a gain, you will pay a depreciation recapture tax on the amount of depreciation that you have claimed previously, up to 25%. So again, if your tax rate is lower than 25%, then you would just pay your tax rate for the depreciation recapture. But here is a trick question. How about if you sell it for a loss? Do you still have to pay depreciation recapture? And the answer is no. If you sell it for a loss, depreciation recapture does not apply. Going back to our conversation about 1231 loss, what is it? It's a tax loss from a sale of a investment property, and you have to hold it for more than 1 year. For example, a rental property. And what's cool about a 1231 loss is that you can deduct the entire loss amount in the current year. You are not limited to the $3,000 limitation like a capital loss. Okay? True story, we have a client who bought a rental back in 2022. He sold it for a loss. We were able to do a 1231 loss as part of his tax plan. And also we were able to combine that with timing his conversion of his traditional IRA into a Roth. And also we were able to qualify him to do a backdoor Roth, which is when you can contribute to a Roth IRA, even if you surpass the income threshold. So we were able to do all those things because we were able to take advantage of the 1231 laws, and we were able to save him about $30,000 in taxes. So that is a big benefit to the client. We were able to take a negative and turn it into a positive for tax purposes. Obviously, nobody wants to lose money on real estate deals, but if you are going to be unfortunate enough to be in a situation where you are going to lose money on a real estate deal, might as well take advantage of it, take that loss, lower your income, and then time it by converting potential retirement accounts into a post-tax retirement account. So what do I mean by that? Because remember, right, when you convert traditional IRA into a Roth a traditional 401k to a Roth 401k, that is considered a distribution, and then you are taxed on that amount. But when you time it with a 1231 loss, you are able to lower your income because of the loss, and then you are able to convert a certain amount of the traditional IRA or traditional 401k to Roth amount while avoiding the tax on it. It is the future, right? Especially if you are a high income earner and you believe that you are going to have a higher tax rate in the future. Might as well take advantage of the loss, have the loss drop you down to a lower tax rate for this current year, and then make that retirement account conversion now at a lower tax rate versus in the future when you have a higher tax rate. So I hope that did not go over your head, you guys. Okay? If it did, feel free to send me an email. We'd love to clarify that for you. So again, about $31, there is no limitations of $3,000 like a capital loss would. Okay, so why should investors care? We have already hit this nail with a hammer multiple times in this presentation because 31 loss can help offset W2 income and active business income as well, which can not only lower your taxable income for the current year, but also present additional tax saving opportunities like converting retirement accounts into a post-tax retirement account at a lower tax rate. So moving along, we already talked about the depreciation recapture. Be mindful of that when you're selling a property that you're probably going to have depreciation recapture. Remember, even if you forgot to take the depreciation in previous years, the IRS is still going to calculate depreciation recapture for you. So might as well take the depreciation, enjoy the benefits of it while you are holding the property. So five costly mistakes is calculating the wrong adjusted basis because that would result into incorrect gain or loss calculation, not including the capital improvement because again that would increase your basis, which would decrease the taxable amounts. Incorrect depreciation calculation, I see that all the time. Allocation errors, I've seen previous accountants forget to allocate land value, which remember land is not depreciable, and also missing selling costs also. So tax planning opportunities, review passive losses, especially if you have suspended losses. That can be a great opportunity to unlock those suspended losses when you sell the property and use those suspended losses to offset active income, right? Because when you sell a property, those losses that were suspended that you were not allowed to use in previous years get freed up. Now you can use them to offset active income. Make sure that your depreciation is correct. If not, no worries, that's an easy fix. Just reach out to our team. We just have to fill out a special form. It's super easy. Make sure that you calculate your basis correctly. And remember, consider the timing of when you are going to take that loss. When you take the loss, look at other opportunities that you can play with as tax strategies. And then, of course, estimate the impact of the tax consequence before committing to a tax strategy. So the biggest mistake of all time is not calling your CPA before you sell a property. True story, you guys. I have a client right now. I'm preparing his tax return right now. I hope you're not watching. He sold a property in 2024. He did not file his taxes in 2024, and he did not do any tax planning. He probably wanted to save money on the tax planning, and now he is facing a big tax bill. I'm talking $30,000 taxes right now, and I told him, "Hey, client, it's too late now. You did not do a tax plan back then. You could have done a 1031 exchange. We could have deferred all of these taxes and also depreciation recapture. But unfortunately, now it's too late. So learn from this client's mistake. Call your CPA before you even sell your property. When you get the idea of selling a property, call your CPA. Hey, Mr. Accountant, what will the tax consequences be if I sell this property? Is it a good idea or a bad idea from a tax perspective? So make sure that you have the adjusted basis, calculate correctly depreciation, calculate correctly, plan before selling, and remember, timing matters, you guys. Timing matters, okay? You always say that size matters, but in taxes, timing matters, okay? So here it is. Pop quiz, get this right, you will get a prize. And that prize is we will take a look at your tax return and we will identify 1 to 2 tax planning opportunities for you that can save you tens, if not hundreds of thousands of dollars in taxes. So let's get to it, okay? So question, all right? Question, that's how you say it in French. Question, if you have a loss from a sale of a rental property, assume that you held it for more than 1 year. Can you use it to offset your active income? Yes or no? Okay. Yes or no? We'll give 30 seconds. Oh, we already have multiple answers, but we can only pick one winner here. Okay, one winner here. So I'm gonna close my eyes. First person that I put my finger on is who's the winner. Okay, it is Samantha. Samantha said yes, that is correct. Samantha, you could use that entire 1231 loss to offset your active income. So Samantha, please stay on, drop your email, your contact information. Our team will reach out to you about that free tax assessment. Okay, so I need to run you guys, but if you have any questions, please feel free to send it to our team, scan that QR code, and feel free to ask us any question that you might have about 1231 laws, tax planning strategies, or if you are thinking about selling a property, whether it's a gain or a loss, please reach out. We'd love to answer your questions. And remember, don't worry, your accountant handles that, especially 1231 losses. Talk to you guys soon. Bye.
Gather the papers, receipts in a row. Punch in the numbers, watch the totals grow. Deductions here, refunds there. You're a tax wizard beyond compare.